This is Peter Gaylord. I'm the CEO of Gaylord Belinsky Wealth Management. In today's video, we're going to talk a bit about bond basics, the basics of investing in fixed income securities, bonds, and other types of fixed income securities. So I'm going to show you a slide on what interest rates and bonds have done over the last 30 years. And when we come back, we'll have a discussion on the basics of bond investing. Talk a bit about the basics of bonds. Many investors are under the misconception that bonds are risk-free, and that to be conservative, you want to buy a lot of bonds and sit there and simply collect interest on them and eventually be paid back the principal amount that you've invested in the bond. Well, unfortunately, the situation is a bit more complex than that. Bonds are not risk-free. There are two elements that can affect the value of the bonds. The first is credit risk, and the second is interest rate risk. Now, credit risk is simply the risk that the issuer of the bond may not pay back the interest and or the principal. For example, we saw recently in Detroit, the city of Detroit went bankrupt, or is attempting to go through the bankruptcy process, and therefore is not going to pay back the bonds that it has issued. So the same thing can happen with a company or any type of issuer, for example. Now, the other risk that one faces when investing in fixed income is interest rate risk. And that is the risk that the value of a bond or fixed income portfolio that you hold will change in price as interest rates in the marketplace change. Now, why would that occur? Well, let's say, for example, you hold a bond that pays a 5% coupon. The value of the bond is $1,000, and you earn a 5% coupon. You would earn $50 each year, say if it was simple interest. Now, if suddenly someone comes out, another issuer, and says, I'll pay 6% on a bond with a face value of $1,000, well, that's more attractive to you. And you're going to be interested in purchasing that bond because it will pay $60 per year in interest. So depending on where interest rates are, the market collectively will bid up the value of that new issue because they want to collect the $60 coupon. Now, the price will go up until the yield of the bond is equal to whatever the prevailing interest rate is in the market. Conversely, if a third issuer came out and issued a bond that only had a 3% yield, paying $30 per year, that wouldn't be as attractive to you as an investor. So you might be persuaded to purchase the bond, but only if you got a discount on the price. And the price will be discounted until the yield that you earn from that bond is equal to the prevailing rate in the marketplace. So interest rate risk is a very important component of purchasing bonds or investing in fixed income that most investors don't understand. And a survey came out recently which indicated that only 28% of investors in the United States understood the next key point, which is that the price of a bond moves inversely to the prevailing interest rates. So as interest rates fall, the price of a bond, the value of the bond will increase. And as interest rates go up, the value of the bond will go down. Now, this is a very critical point because depending on whether or not you invest in a bond fund or purchase an individual bond, if you don't intend to hold it all the way until maturity, you can't be sure you're going to get all of your principal value back. The amount you get for the bond will fluctuate based on what interest rates are doing. So interest rate risk is a very critical component. The next thing we need to talk about is a measure called duration. And when you look at prospectuses or funds or ETFs or whatever that invest in fixed income or individual issues, you'll often find an indication of the duration of that bond. Now, what is duration? Duration, in very simple terms, is simply the weighted average of the cash flows that you're going to receive for that bond. Now, for example, if you have a bond that pays a 5% yield, say $50 per year, for 10 years, you'll have a $50 cash flow in year 1, in year 2, in year 3, and so on up through year 10, and then you'll also get the $1,000 principal back at year 10. So the weighted average of those cash flows measured in years determines the duration of the bond. If you have what's called a zero coupon bond, which pays no coupon, the duration of the bond will simply equal the maturity of the bond in years. Say if it's a 10-year bond, the duration will be 10. Now, if the coupon rate on a bond is higher, all else being equal, the duration is going to decrease in terms of years because you're receiving more of your cash up front before the actual maturity of the bond. On the flip side, if the coupon is lower, the duration of the bond is going to increase. And the reason for that is that a larger percentage of the cash flows will be returned to you upon the maturity, the bond maturing. Now, this becomes very important because the duration of the bond is going to be a good indication of the price sensitivity that you have for that instrument. And as a general rule, sort of a very simple rule of thumb, is that a 1% change in yields, or the prevailing interest rate in the marketplace, will drive an inverse 1% change in the value of a bond for every year of duration. So, for example, if you have a bond, let's say it's a 10-year Treasury bond, and prices move up, or yields move up 1%, 100 basis points in the marketplace. And this bond, let's say it's a zero coupon bond. It's going to have a duration of 10. So with a 1% increase in yield, the value of the bond will decline by 10%. So it's very critical that you understand the duration of your bond, your fixed income portfolio, and have a sense of what interest rates are going to do in the marketplace. So as we can see, if you're a more sophisticated investor, you now understand that bonds are not risk-free. It's not like putting money in a bank account, an FDIC bank account, and earning interest on it. The value can change, and it's driven by two things: credit risk and interest rate risk. So I hope this has been very helpful. Well, I hope you found this discussion of bond investing today and the basics of investing in fixed income to be helpful. If you need assistance or want to consider your investing needs, we would love to talk to you, Gaylord and Belinsky. Our contact information is in the comments section below on this video. You can also follow us on Twitter at Gaylord Belinsky. And we'll be doing a lot of videos here on our YouTube channel that we hope you'll find of interest. Thanks very much.